Hi there, this is Justin, and today we'll be talking about bonds. If a company wants to raise some money in order to fund its business activities, it can either sell stock or issue bonds. If the company is a private company, it can sell stock to relatively fewer people, and if it's a public company, it can sell stock to the wider market, potentially through a stock exchange. This means if you own stock in a company and the company does well, the value of the stock will increase, and if the company does poorly, the value of that stock will decrease. The company directors have an obligation to treat their shareholders fairly, but don't really have any obligation beyond that. The other way that a company can raise money is by borrowing, and typically they do this through issuing a bond. If you go ahead and buy that bond, you are lending the company in question money, and the obligations of the company are typically written onto the bond itself. Like a share certificate, companies used to issue, and some still do, physical bonds, pieces of paper, with a variety of features, including usually a maturity date and a coupon, which in its paper form used to be a tear-off side of the bond with the annual interest portion of the bond. So if it was a $100 bond, the coupon may say 5 cents on it, which means the holder of the bond would be entitled to 5 cents every year until maturity, when the company was obligated to pay back the principal of $100. Now, like shares in the company, bonds can also be traded on the secondary market, and the price of the bond will go up and down depending on a few major things. The first thing is prevailing interest rates. If the company issued bonds that produced 5% interest when they were issued, and interest rates were at that time 4%, but now are 6%, that makes the bond a slightly worse deal. So if you were selling that bond, you might get less than $100 for it. The second major factor that impacts the price of the bond on the secondary market is how well the company is doing, because that in turn affects the likelihood of the company being able to pay back the bond at the maturity date. And again, that can go up and down depending on how the company is doing. And the final major factor that impacts the price of the bond is how close we are to the bond paying its coupon. If it's a few days before the bond pays the coupon, the bond will be slightly more valuable than if it had just paid its coupon a few days prior. Finally, one of the most important things to know about a bond is that it's in fact a contract, and the issuing company has very specific obligations that they don't have when they issue shares in themselves. And that can be for better or for worse. So typically bonds are considered lower risk than shares or stock in the same company, because so long as that company exists at all, they're mandated to fulfill the terms of the bond contract. In the next video, we'll talk about some more specific things on bonds, how they work, how they function in real life. But for now, that's all.